And welcome back, everyone, to the Elevated Trader podcast. We are in part 3 of the new Trading for a Living book by Dr. Alexander Elder. And Kristen, it's great to be back with you. How are you doing?
I'm doing pretty good. It's getting chilly here.
Yes, here as well.
Yep. You're freezing. We're your summer degrees. Got it.
It's all good. So how are you making it through this book? We're into parts 4 and 5 we're going to cover today, correct?
Oh, this book is, I don't know. I think it's my mindset, to be honest with you. I'm pushing through it. I'll just say that.
Yeah.
I'm pushing through it. I think it's just because maybe it's been quite a few years, or maybe it's just stuff that we read a lot. I don't know. What do you think?
Well, you touched a little bit on that last time by saying, that this is very beginner oriented. It's almost written as an inclusive encyclopedia for trading. That's kind of the way that I'm seeing it. Like it goes into everything. So there's a lot of stuff that if you are a more seasoned trader, you're not really going to benefit from it. You're going to be pushing it away because you've either already heard about it or you have a system that you like and you don't want to go down a rabbit hole. But if you are so far.
Yeah. Because what do you think? Are we halfway?
No, we're not even halfway. I don't think. No, I think there's 20 parts or something like that.
So if you're a seasoned trader, we'll let you know what chapter you can start at.
Exactly.
Okay,
but
got it.
Up until this point, I mean, if you were a new trader, brand new to trading, then this is a great introductory to just about every concept you can think of that you can start to fully understand how certain things work and then kind of try them out for yourself and see what you like and what you don't like. Yeah.
With chart images and stuff like that too.
Yeah, exactly.
Yeah.
Exactly.
So
that's
helpful.
Part 4. What's been your biggest takeaway so far?
I guess having to put myself in the mindset of, honestly, like what really stood out when I was learning was the point where he talks about following. One of the keys is to make sure to follow the large indexes. Mm-hmm. So the Dow, the NASDAQ, the S&P, and then to steer from day trading, which I was also taught. I still so I can sit there and put myself back to that first seminar that I sat in, and what were the big, takeaways was to, one of the sayings used to be, and I don't think it's in this book, but it's follow the tide. Like if one boat is rising, go that direction. It was more talking about the Dow. The Dow lifts all boats, that kind of thing. So yeah, I mean, that's pretty much kind of what stood out. What about you?
Well, let's talk about the ones that you've actually brought up. Let's talk about looking at the indexes. Why is that important to know kind of what's happening with the other indexes? You kind of hinted on it with the whole one tide lifts all boats.
Right.
So if you were considering trading, and let's say that you're not going to trade the indexes. Let's say that you want to trade an individual stock because you like it. Why is it important to actually look at the indexes? And I personally believe that, as you mentioned, the tide's going to lift all the boats. And if you are looking for gaps or something like that, then you need to figure out what's causing that gap if you want that stock to kind of run in its own direction. Otherwise, it's going to just kind of move the same as the indexes. And that's kind of why it's important for you to be viewing what's happening with the indices, right? Because that gives you a global view. That gives you that insight onto what's happening with the rest of the boats.
Okay, so we're in 2022. We're at the end of 2022, and let's talk about that, right? So big stocks like Apple is obviously in the NASDAQ, but it's also in the Dow and in the S&P, right? I mean, that's, because I feel like professional traders are typically just trading probably a small handful of stocks. And then they say that stocks have their own personalities, which I do agree with. So if you're going to do, watching the indexes, and when you're trading a particular stock that's heavy weighted in one of those indexes, you want to know what the index is doing. That's the
Agreed.
way I see it and how I read it. Okay.
Yeah, totally agreed. But the reason that they're going to be tracking each other, the reason that those individual stocks are going to track is because there's no real catalyst to force it outside of that region. There's no reason for it to operate any differently than the indexes are running, if that makes sense. So it's just going to ebb and flow. And because of all sorts of different people involved in the markets, you're going to have a lot of longer time frame, lower time frame, retail traders, commercial traders, mutual funds, all sorts of people that are going to be rebalancing portfolios, you name it. And unless you have a catalyst event that's going to force something to deviate from that, which is typical for earnings and things like that, right? Specific news events on certain things. Yeah. And when they have small weight inside of those indexes, then they can deviate pretty drastically from what the actual index is doing on their own. But stuff like Apple, as you say, when they have a catalyst event, then the index will tend to run with Apple. Apple can have a huge impact on that index, vice versa, right? So that's kind of the way that we look at it. So that's why it is important and what have you. You and I focus specifically on the indexes, and so we're really
watching
need
them.
to worry. Yeah. But that being said, you can still, even if you're trading the indexes, taking a look at some of the big players like Microsoft and Apple and some of the heavier weighted companies inside of your index that you're trading is really good to look at. Absolutely. Now, you mentioned, what was the other thing that you mentioned?
Oh, that day trader, if you're a beginner, to steer clear of day trading.
Yeah. Why do you think that that's the case?
Oh boy. I think you have to be quicker on your feet. I think you have to be able to read charts much better. I think it's a tiny approach and more specific versus a global approach. So I just go back to where I started, which was swing trading. And then I went into swing trading options. And so then I was tired of dealing with all the option costs. And then that's why futures became so attractive, because of just the tax savings and all the things, right? So very interesting. Once I also feel like trading is very similar. Like the type of trading you end up doing is similar to your personality. So honestly,
what does futures say about us? That's funny.
Adrenaline. We want to be in the moment. I don't know. That is interesting. People think that it's like really crazy and weird to trade futures. I'm thinking, it's gotta be the easiest.
I love it. I love trading futures. I always loved trading futures. And then when I went back from futures to stocks, I missed futures, missed it a lot. And now I'm back trading futures. So it's, I feel like I'm home, settled.
Yeah, I don't miss, I do like swing trading. And I do like swing trading options. I do not miss day trading options.
Yeah.
On a stock. That's painful, especially if you don't know what you're doing. So again, there we go. It's like the less you know, stay in the bigger time frames.
It's fractal, right? And if you completely understand that the markets are fractal, the bigger time frame gives you more time to think, more time to react, more time to process information, set up your trades, plan your trades, learn all of that type of thing. And if you understand that and know that because it's fractal, you can take the skills that you acquire from swing trading and bring them down into a lower time frame and eventually day trade once you develop that skill. And it's no different than anything that you learn. You get good, then you get fast. And that was something that somebody said to me. Well, I know who said it to me. It was my apprenticeship, my pre-apprenticeship instructor. And I remember him very clearly saying that you get good and then you get fast. And I've always taken that into just about everything that I do, which is one of the reasons I love to practice, because I like to get good, then I'll get fast. So
I can appreciate that. And all the different things in life, right? Even cutting grass.
Absolutely. Well, even chiropractic work. I mean, do you remember when you first started working as a chiropractor? You know, you probably had all of these things going through your head of all of your learning. And the very first patient probably took the longest time. And as you got your skill developed and as you got better at it, you've just gotten faster and faster and faster, right? You don't even have to process some information anymore, correct?
Ooh, that's called flow.
There you go.
In flow. Yeah. Super cool. Yeah. And that really helps when you have confidence too. When you just are like, oh yeah, I get this. I got this. That makes sense. And I just want to point out that twice when you were talking about fractals, you were attempting to be very clear by using the word, when you understand. Just so we're clear that you must understand fractal. We are not explaining fractal. So if you don't know what that means, go learn what fractal is and what it means and how it works.
Well, let's just explain it right now. Fractal.
Okay. I'll let you do it. No, so, I know. I could do it in a basic term and then you can clean it up.
Sure. Go ahead.
Basically, the things that you see on larger time frames, like Fibonacci's and moving averages, can be used the same on a smaller time frame.
Exactly. As the patterns repeat themselves as you zoom in closer and closer and closer and closer. Look up Mandelbrot set. It's a great example. If you look up what a Mandelbrot set is, that's a clear example of what fractal is. That is a fractal. So
that's funny. So living on the beach and walking the beach all the time, every time I see a spiral. So because shells are broken, right? Or you can pick up a shell, but when they're broken, then the top's off and you just get to see that spiral of a shell. I'm like, Fibonacci's, fractals, we got it. It's right here. It's right here in nature.
It is everywhere.
It is
very, very cool. So, no, that's awesome. And is there anything else that stood out to you in part 4?
There was that fun little history piece. It says Wall Street old timers say that moving averages were brought to the financial markets after World War II. Anti-aircraft gunners used moving averages to sight guns on enemy planes. And after the war, they applied this method to moving prices.
Interesting.
It is interesting.
I've never heard that before. I wonder how accurate it is. I'm sure it's pretty true, but like I said, I've never heard it before. So that's an interesting fact.
Anti-aircraft gunners.
Yeah. It's just incredible. Once again, how technology and things innovation comes from just thinking outside the box, right? Mm-hmm. Taking theories from something else and applying them to new ways. I just think it's very cool, right? I mean, even the development of the candlestick came from, charting rice sales, right? We talked about that. So it's
that really cool. Stands out in that book. That little piece of history is that book's huge, by the way.
Yeah.
If you haven't read that, if you want to use mine, I'll send it to you. I'll sell it to you. I don't know if I'm ever going to open that book again. That is not true for a lot of the other books that we've read. One of the things that you said that stood out to me before we were recording was about the history of cycles.
Oh, yes. So that's going into part 5, where he brings up cycles. And I think that's really important to understand as well, because the markets do have cycles, and understanding kind of some of the economic factors, weather factors, even agricultural factors that play into whatever instruments you might be trading. A clear example was COVID, the COVID drop. Well, when you start looking at that event, that is such a huge catalyst event. You can start to look at companies that could possibly profit and benefit from something like COVID, like a pandemic. Well, what's going to start happening from there? You're going to start to see the airline stocks deplete. Why? Because travel was restricted. That's going to have some kind of an effect, right? It's not so much of a cycle per se, but it is it's an event that can cause something to, it's a correlation. Let's just put it that way. And then looking at some of the internet-based stocks, shopping from online, all of those types of things, if you were positioned really well.
Zoom.
Yeah, exactly. Online broadcasting companies, that type of stuff is all going to benefit from having something like a pandemic. So there's that. But what he was explaining was for example, if you traded the commodities of cows, okay, which you can trade cows. And just a little side note that when you're trading futures, it settles in actual products. So if you actually let your contract expire, you'll get a bunch of cows. You'll get a bunch of cows on your lawn. So make sure that you get rid of that beforehand and don't let it settle, because you don't really want those cows. But anyway, if you are actually trading cows, there's a cycle in the agricultural business or in the cow cycle of when they're bred and when they're sold, and then when they're started as small animals and then, grown, however you want to do it, fed before they go to auction again. And that's a cycle. It's a cycle that happens every single year.
Yeah.
Corn, it grows at a certain time of the year and then it gets harvested. So there's cycles that happen. Hurricane season, that's a cycle. There's weather patterns, and that can affect certain stocks in positive and negative ways. And understanding those cycles helps you, again, position yourself into better situations within the stock market, right? So if you understand the correlations and you know what's happening within the markets that you're trading. So that's important to understand kind of what is the underlying product that you're actually dealing with. Even in the indexes, if you're operating or trading the NASDAQ, for instance, that's highly leveraged in tech. So a lot of the tech industry is going to be affected by tech news and things that are all tech related. So you might want to have your finger on that kind of aspect of the news and aspect of, up and coming R&D and information technology, all that kind of stuff, right? You want to kind of know what's happening in that world to give you an idea of what might be coming and going, right?
Yeah. And I think that's also feeds into like allocation of portfolios, because if you're just heavy, I mean, I know so many people that are heavy tech, because tech was running for so many years so fast. There's some portfolios out there that have people panicking. I literally just had someone telling me the other day, she went back to work after just retiring. And I was like, oh, but I remember this in 08 and 09 and all that. These people losing everything in their portfolios. Portfolios are,
and that leads me into the next thing, right? And that is the fact that he talks about looking at least two other time frames above the time frame that you're wanting to trade in. So if you're a day trader, right, then you need to really look at the weekly and the monthly chart. Get a clear understanding of what's happening in those charts. If you're a swing trader and let's say you trade the hourly, then you need to be looking at least at the daily and the weekly. Just get some reference points of what's happening in those two bigger time frames. And the reason being is because as you trade in a smaller time frame, your outlook or the length of position that you're planning on holding is going to be shorter. So really the effect that those bigger time frames are going to have is going to take place inside of that two time frame higher, not necessarily higher than that. So for instance, what happens on an intraday 3-minute chart is going to be more visible in a 15 or a 30-minute chart versus paying attention to what's happening on the daily. There might be some key points on the daily that you need to pay attention to, but really it's not going to affect what's happening intraday too much. It will give you context and a starting point, but not necessarily throughout the day. Looking at that 30 and that 15-minute chart, however, or even the hourly chart, could give you a little bit more insight to potential turning points or potential balancing areas or changes that are happening within that time frame, so you can see them a little bit sooner. Does that make sense?
100%.
Yeah,
totally.
So I think that's really important. And if you're a swing trader, for instance, looking at that weekly and monthly, there may have been visible signs that are saying, hey, things are getting a little bit overextended. Maybe it's time to start either protecting my positions or locking in some profits, because you're right, tech has been on a huge run for a very long time. And the other thing is, if you look at, say, a monthly chart or a weekly chart, and you start to see, there's cycles, right? Cycles of bull runs and then cycles of bear runs. The bear runs are always smaller than the bull runs. They don't last as long. Then a new bull run comes back in. So if you start to see that you're in a big, long bull run, start expecting that bear run to come in at some point, right? That's just the way it is, because it's cyclical. It does happen. You can't keep going up forever. You run out of buyers. So that's just a reality. Right?
Yeah, and we're in a chop situation here. Currently, I feel. Chop with down. Yep, that's fun.
Yeah. So
if you haven't lived through it, those people that only have learned, to trade in an uptrend, that's really hard for them to switch gears. Winning. When I first got in, it was just going into a sideways market.
Right.
And that was hard to learn in, for sure.
Well, I think that, like I said, understanding the context of what you're doing is huge. And that bigger time frame can give you some bigger clarity into what you are doing. And I think that's important. I think it's very important for you to get the full context of what's happening, because we are so keen on putting blinders on and just focusing on the intraday that we forget what's happening on the bigger time frames, or vice versa. And that can bite you in the butt if you don't recognize what's happening on a bigger time frame. You can have a very bearish move intraday, but it is on a bigger time frame just a minor pullback and a bullish run. So even though the intraday price action was very bearish, understanding that this is still counter trend to the big trend, knowing that there's going to be a point where buyers are going to step in because it's trending in one direction. Understanding that is extremely helpful. Right now, we've been moving down. We've been in a bearish trend. So these bull runs, understanding that, knowing that the bullish run on a bigger time frame is coming into areas where longer term selling might take place again. That's key to understand. So it helps you recognize the context of what's happening. So even though you can play those bullish moves intraday, you need to be wary, because at some point a bigger time frame could be stepping in and run right over you. Right?
Yep.
Yeah. So cool. All right. Well, I guess that's it for part 4 and part 5 of this book. We will see you next week for part 6 and part 7.